Hello, everybody. This is Empowering Democracy. I'm your host, Joe Firestone. My topic for tonight is why the bank crisis isn't over. That was the title of a post, an article by Michael Hudson, uh, the distinguished economist who holds a chair at the University of uh, Missouri at Kansas City. Uh, we'll be covering that article, also a second article that he wrote, and some other articles from Common Dreams concerning the legal aspects of uh, the Silicon Valley Bank affair. I'll probably be joined by Dee Peers after a while, but she may still be completing her show with Brandy Weaver very soon. Hiya, Kay. How you doing? Uh, Kay Ryan is here. Uh, so I'm going to get right into it because I have a lot to cover tonight. I'm going to start with the first article, which is background. That was published on March 13th, just a few days ago, March 13th, 2023. And it is by way of background of some of the rest of the things we're going to go over. I think I have it shared now. Let me check that out. Yes, I am sharing Counterpunch. So, the title of that article is Why the Banking System is Breaking Up. It's also a Michael Hudson article. And you have a picture of a bank window. It's broken with some graffiti on the wall saying, "Burn the banks." The collapses of Silvergate and Silicon Valley Bank are like icebergs calving off from the Antarctic glacier, says Michael Hudson. The financial analogy to the global warming causing this collapse is the rising temperature of interest rates, which spiked last Thursday and Friday to close at 4.60% for the U.S. Treasury's 2-year bonds. Bank depositors, meanwhile, were getting paid only 0.2% on their deposits. This has led to a steady withdrawal of funds from banks, that is, withdrawal of deposits, and a corresponding decline in commercial bank balances with the Federal Reserve. Most of the media reports reflect a prayer that the bank runs will be localized, as if there is no context or environmental cause. There is general embarrassment to explain how the breakup of banks that is now gaining momentum is the result of the way that the Obama administration bailed out the banks in 2009. 15 years of quantitative easing has reinflated prices for packaged bank collections of mortgages. In other words, they're going back to packaging mortgages. And with them, housing prices, stock, and bond prices. packaging the mortgages into CDOs and CDSs again. That was one of the primary causes of uh, the collapse, the crash of 2008, 2009. The Fed's $9 trillion of QE, not counted as part of the budget deficit, because defense spending is not counted, as part of budget spending, fueled an asset price inflation that made trillions of dollars for holders of financial assets, with a generous spillover for the remaining members of the top 10%. The cost of home ownership soared by capitalizing mortgages at falling interest rates into more highly debt-leveraged property. The U.S. economy experienced the largest bond market boom in history as interest rates fell below 1%. The economy polarized between the creditor-positive net worth class and the rest of the economy, whose analogy to environmental pollution and global warming was debt pollution, says Michael. But in serving the banks and the financial ownership class, the Fed painted itself into a corner. What would happen if and when interest rates finally rose? In Killing the Host, which is a book that Michael wrote, I believe, in 2015, I wrote about what seemed obvious enough. Rising interest rates caused the prices of bonds already issued to fall, along with real estate and stock prices. Now, it should be clear to you that what he's talking about here is the market prices of bonds, situations where the bond holders want to sell their bonds in the private markets. The actual prices of bonds, are determined by the Treasury Department. In other words, the Treasury Department has a selling price for the bonds, and that's what you have to do to get a bond from the Treasury. But what's being said here is that the rising interest rates caused the market price of bonds that had been already sold to the public to fall, along with real estate and stock prices. That is what has been happening under the Fed's fight against, quote, inflation, unquote, which is its euphemism for opposing rising employment and wage levels. Prices are plunging for bonds and also for the capitalized value of the capitalized value of mortgages that have been packaged and other securities in which banks hold their assets on their balance sheet to back their deposits. The result threatens to push down bank assets below their deposit liabilities. Here I want to make clear, because I think the language is sometimes very confusing when they refer to assets and liabilities in this particular context. A bank asset is not a deposit. A deposit is a liability of banks because the banks are supposed to give back your deposit when you want it back. If you deposit the dollars into a checking account, that is not an asset of the bank. It's a liability of the bank because you can write checks on that deposit, or you can demand that the bank give you back the deposit whenever you want to. So the banks, when you talk about the assets of banks, you're talking about separate capital assets or financial assets the banks are holding. You're not talking about deposits. Deposits, again, are liabilities of the banks. Anyway, the result threatens to push down bank assets below their deposit liabilities, wiping out their net worth, their stockholder equity. This is what was threatened in 2008. It is what occurred in a more extreme way with savings and loans and savings banks in the 1980s, leading to their demise. These, quote, financial intermediaries did not create credit as commercial banks can do, but lent deposits out in the form of long-term types of mortgages at fixed interest rates, often for 30 years. But in the wake of the Volcker spike in interest rates that inaugurated the 1980s, the overall level of interest rates remained higher than the interest rates that S&Ls and savings banks were receiving. Depositors began to withdraw their money to get higher returns elsewhere because the S&Ls and savings banks could not pay their depositors higher rates out of the revenue coming in from their mortgages that were fixed at lower rates. So even without fraud Keating style, the mismatch between the short-term types of liabilities and the long-term interest rates ended their business plan. The S&Ls owed money to depositors short-term, but were locked into long-term assets at falling prices. Of course, S&L mortgages were much longer term than was the case for commercial banks, but the effect of rising interest rates has the same effect on bank assets that it has on all financial assets. Just as the quantitative easing interest rate decline aimed to bolster the banks, its reversal today must have the opposite effect. And if banks have made bad derivatives trades, they're in trouble. Any bank has a problem of keeping its asset valuations higher than its deposit liabilities. When the Fed raises interest rates sharply enough to crash bond prices, the banking system's asset structure weakens. That is the corner into which the Fed has painted the economy by quantitative easing. The Fed recognizes this inherent problem, of course. That is why it avoided raising interest rates for so long, until the wage earning bottom 99% began to benefit by the recovery in employment. When wages began to recover, the Fed could not resist fighting the usual class war against labor. But in doing so, its policy is turned into a war against the banking system as well. I can't help appreciating that. It's, it's Schadenfreude again. Anyway, Silvergate Bank was the first to go, but it was a special case. It had sought to ride the cryptocurrency wave by serving as a bank for various currencies. After SBF's vast fraud, that's Sam Bankman-Fried's vast fraud was exposed, there was a run on cryptocurrencies. Investor gamblers jumped ship. The crypto managers had to pay by drawing down the deposits they had at Silver Lake. Silver Lake Bank went under. Silvergate's, he said Silver Lake here, it's actually Silvergate. It went under. Silvergate's failure destroyed the great illusion of cryptocurrency deposits. The popular impression was that crypto provided an alternative to commercial banks and, quote, fiat currency, unquote. But what could crypto funds invest in to back their own coin purchases, if not bank deposits and government securities or private stocks and bonds? What is crypto ultimately, if not simply a mutual fund with secrecy of ownership to protect the money launderers, says Mike Hudson. Silicon Valley Bank also is in many ways a special case, given its specialized lending to IT startups. The New Republic Bank also has suffered a run, and it too is specialized, lending to wealthy depositors in the San Francisco and Northern California area. Can't help wondering whether Nancy Pelosi was one of the people who used the New Republic Bank, or even Newsom. But a bank run was being talked up last week, and financial markets were shaken up as bond prices declined when Fed Chairman Jerome Powell announced that he actually planned to raise interest rates even more than he earlier had targeted. Rising employment rates make wage earners more uppity in their demands to at least keep up with the inflation caused by the U.S. sanctions against Russian energy and food, and the actions by monopolies to raise prices, quote, to anticipate the coming inflation, unquote. Wages have not kept pace with the resulting high inflation rates. It looks like Silicon Valley Bank will have to liquidate its securities at a loss. Remember, this article was written on May 13th. Okay, and he must have written it before the news broke that Silicon Valley Bank was going into receivership. So it looks like Silicon Valley Bank will have to liquidate its securities at a loss. Probably it will be taken over by a larger bank, but the entire financial system is being squeezed. Reuters reported on Friday that bank reserves at the Fed were plunging. In other words, the banks were taking their reserves out of the Fed, so the reserve levels were much lower. Michael says that hardly is surprising, as banks are enjoying record interest rate spreads. No wonder well-to-do investors are running from the banks. The obvious question is why the Fed doesn't simply bail out banks in SVB's position. I wondered that actually myself. I wondered why the Fed just didn't buy up the securities that SVB had, the longer term securities that SVB have, and give it back cash so it could remain liquid. Michael says, anyway, the answer is that the new lower prices for financial assets looks like the new normal. For banks with a negative equity, how can solvency be resolved without sharply reducing interest rates to restore the 15-year zero interest rate policy, ZIRP, okay, as we MMTers call it? There's even larger elephant in the room: derivatives. Volatility increased last Thursday and Friday. The turmoil has reached vast magnitudes beyond what characterized the 2008 crash of AIG and other speculators. Today, JP Morgan Chase and other New York banks have tens of trillions of dollar valuations of derivatives, casino bets on which interest rates, bond prices, stock prices, and other measures will change. For every winning guess, there is a loser. When trillions of dollars are bet on, some bank trader is bound to wind up with a loss that can easily wipe out the bank's entire net equity. There is now a flight to, quote, cash, unquote, to a safe haven, something even better than cash: U.S. Treasury securities. Despite the talk of Republicans refusing to raise the debt ceiling, the Treasury can always print the money to pay its bondholders. It looks like the Treasury will become the new depository of choice for those who have the financial resources. Bank deposits will fall, and with them, bank holdings of reserves at the Fed. So far, the stock market has resisted following the plunge in bond prices. My guess is that we will now see the great unwinding of the great fictitious capital boom of 2008 to 2015. So the chickens are coming home to roost, with the quote chicken unquote being perhaps the elephantine overhang of derivatives fueled by the post 2008 loosening of financial regulation and risk analysis. So that's kind of a preview to the next piece by Mike Hudson. Looks like Dee Pierce has joined us. Let me bring her in. Hello, Dee.
Hello, Joe. So how you doing tonight?
I'm doing fine tonight. Fine tonight. Thank you, Dee. I just got through reading the first article of the night and commenting on it, of course, as I went. That was an article by Michael Hudson, uh, which was written on the 13th, and it sort of set the stage for the second article that he wrote on the 15th, which is really the key article.
Okay.
And that talks about why the bank crisis isn't over. So I'm going to share that and we can get into it. And I'll give you a chance to comment on it
Oh,
as I continue to read it.
okay, that sounds good.
Okay. So, uh, so this was also from Counterpunch on March 15, 2023. Why the bank crisis isn't over. And let me get this out of your way. Let me check to see whether I'm showing this or not. Yes, I am. Very good. Okay. So there's a little picture of junk by a riverside with a bridge in the background. The crashes of Silvergate, Silicon Valley Bank, and Signature Bank, because also Signature Bank failed about the same time as Silicon Valley Bank. The related bank insolvencies are much more serious than the 2008 to 9 crash. The problem at that time was crooked banks making bad mortgage loans. Debtors were unable to pay and were defaulting. And it turned out that the real estate that they had pledged as collateral was fraudulently overvalued. Quote, marked to fantasy, unquote, junk mortgages made by false valuations of the property's actual market value and the borrower's income. Banks sold these loans to institutional buyers such as pension funds, German savings banks, and other gullible buyers who had drunk Alan Greenspan's neoliberal Kool-Aid, believing that banks would not cheat them. Can you imagine people believe that? Silicon Valley SVB investments had no such default risk. But the Treasury always can pay, simply by printing money. And the prime long-term types of mortgages whose packages SVB bought also were solvent. The problem is the financial system itself, or rather the corner into which the post-Obama Fed has painted the banking system. It cannot escape from its 13 years of quantitative easing without reversing the asset price inflation and causing bonds, stocks, and real estate to lower their value in the market. In a nutshell, solving the illiquidity crisis of 2009 that saved the banks from losing money at the cost of burdening the economy with enormous debts paved the way for the deeply systemic illiquidity crisis that is just now becoming clear. I cannot resist, says Michael, that I pointed out its basic dynamics in 2007 in Harper's Magazine and in my 2015 book, Killing the Host. Next section is about accounting fictions versus market of reality. No risks of loan default existed for the investments in government securities or packaged long-term types of mortgages that SVB and other banks have bought. The problem is that the market valuation of these mortgages has fallen as a result of interest rates being jacked up. The interest yield on bonds and mortgages bought a few years ago is much lower than is available on new mortgages and new Treasury notes and bonds. When interest rates rise, these old securities fall in price so as to bring their yield to new buyers in line with the Fed's rising interest rates. A market valuation problem is not a fraud problem this time around. The public has just discovered that the statistical picture that banks report about their assets and liabilities does not reflect the market reality. Bank accountants are allowed to price their assets at, quote, book value based on the price that was paid to acquire them, without regard for what these investments are worth today. During the 14-year boom in prices for bond stocks and real estates, this undervalued the actual gain that banks had made as the Fed lowered interest rates to inflate asset prices. But this quantitative easing, QE, ended in 2022 when the Fed began to tighten interest rates in order to slow down wage gains. When interest rates rise and bonds fall, stock prices tend to follow. But banks don't have to mark down the market price of their assets to reflect this decline if they simply hold on to their bonds or the mortgage packages they hold. They only have to reveal the loss in market value if depositors on balance withdraw their money and the bank actually has to sell these assets to raise the cash to pay their depositors. So again, why didn't the Fed just intervene and buy the bonds back at their original price? Why didn't they just do that and give Silicon Valley Bank the cash? That would have allowed it to stay liquid. Well, they didn't. So, going on with Michael's article, this is what happened at Silicon Valley Bank. In fact, it has been a problem for the entire U.S. banking system. The following chart comes from Naked Capitalism, which has been following the banking crisis daily. Okay, the blue is the value of the held to market securities. I'm sorry, the held to maturity securities. The beige is the available for sale securities. And you can see that as the years have gone by, the value of the held to maturity securities remained high, and the available for sale securities also remained high. But then suddenly, in the last few years, the available for sale securities, there's far less in gains for the available for sale securities, and the value of the held to maturity securities is going down. So you get unrealized gains or losses on investment securities. But going from left to right, there were unrealized gains all through this period of time. But then in 2022, there are unrealized losses that are becoming common, both in the available for sale securities and in the held to maturity securities. Source of this graphic was the FDIC itself. And you see, this had never happened starting in 2008. There was a little period where it was happening somewhat. But beginning in 2009 and at the end of 2008, it shifted to unrealized gains almost all the time. And then suddenly in 2022, the bottom drops out of the market. That's what that graphic is showing. Okay, the next section is entitled How SVP's Short-termism Failed to See Where the Financial Sector is Heading. Okay, before we get into that, D, okay, was that last part clear to you?
Yes. And what really bothers me is that you have these people that are supposed to be experts just letting things happen.
Yeah, letting things happen. Okay, and also not recognizing apparently or realizing that this run of raising interest rates was going to cause this problem for banks. Okay, we have to remember the primary responsibility of the Federal Reserve, even more primary than hedging against inflation, is the Federal Reserve's primary job of maintaining bank stability. And yet, when Jay Powell and the others began to raise the interest rates so vigorously after a very, very long period of close to zero interest rates, they just didn't seem to see that they were jeopardizing the stability of middle-sized banks. Maybe they were only watching the big banks and noticed the big banks were in good shape and didn't care what happened to the middle-sized banks. But obviously, from the three failures we had so far, three middle-sized banks, now they've taken steps to try to fix things we'll be talking about whether these really will fix things.
And
But
there's been a lot of talk about this too, for the past year or more, talking about a crash coming, a crash coming, a crash coming. And after a while, I was listening. At first, I was listening to some people, and then I just stopped because I just was like, I don't need to be. It can get you tense when you listen to these people constantly bringing this up.
you're right. But the
And
crash, we have to emphasize, the crash the Fed was expecting was a crash in the labor market. It was expecting a recession, that it would cause a recession by raising the interest rates. It was engaging, as Mike Hudson puts it, in its normal class war against the working people of the United States.
yes,
Now, there were some of the MMT people, actually, Stephanie Kelton, now for some time, has been warning the Fed is going to break something.
yes,
Now, she wasn't only talking about the labor market, she was talking about breaking something in the banking system.
mm-hmm.
And the bankers of the Fed were just not listening.
No, and she wasn't the only one saying that.
No,
And
she wasn't the only one. A lot of people were saying that, were talking to the Fed and saying, better stop. What you're doing is dangerous.
who
But
profits off of it?
Powell was living in the 1980s. He was looking at Paul Volcker, okay, what Paul Volcker did. Okay, and of course, Paul Volcker didn't have the same kind of economy. When he did what he did, which by the way was terrible and had really terrible effects for a while anyway,
Mm-hmm.
which redounded actually to the interest of the Republicans, uh, it didn't follow a period of low interest rates, particularly low interest rates, of zero interest rates with a lot of asset inflation. That didn't happen during the 1970s. So Powell didn't recognize he had a different situation on his hands. But anyway, to go on with the article,
Well, I have to ask you one question. Who profits off of this?
who profits off of this? Well, uh, speculators profit off of it because what speculators can do is, as the value of the previously bought bonds falls, speculators in the market can pick up those bonds, okay, at lower prices.
Mm-hmm.
They can sweep in, okay, and grab a whole bunch of them, and they have the capital power to hold them. And eventually, of course, they basically get the full price for the bonds. So they're making a killing in that way. So speculators, okay, are uh, going to benefit. And of course, the Fed thought that there would be a general benefit in the economy because it would kill inflation. Okay, during the years of low interest rates, the U.S. banking system found that its monopoly power was too strong. It only had to pay depositors 0.1 or 0.2% on the deposits. That was all that the Treasury was paying on short-term risk-free Treasury bills. So depositors had little alternatives. But banks were charging much higher rates for their loans, mortgages, and credit cards. Tell me about it. Tell us all about it. Because we were victims of that. And when the COVID crisis hit in 2020, corporations held back on new investments and flooded the banks with money that they were not spending. The banks were able to make an arbitrage gain, obtaining higher rates from investments than they were paying for deposits by buying longer term securities So Silicon Valley Bank bought long-term treasury bonds. The margin wasn't large, less than 2 percentage points, but it was the only safe, free money around. Last year, Federal Reserve Chairman Powell announced that the central bank was going to raise interest rates in order to slow, thank you, honey, in order to slow the wage growth that developed as the economy began to recover. That led most investors to realize that higher interest rates would lower the price of bonds, most steeply for the longest term bonds. Most money managers avoided such price declines by moving their money into short term treasury bills, exactly as Warren Mosler would have predicted, or money market funds, while real estate, bond, and stock prices fell. However, it was left holding the bag when Mr. Powell announced that not enough American workers were unemployed to hold down their wage gains. So he planned to raise interest rates even more than he had expected. He said that a serious recession was needed to keep wages low enough to keep U.S. corporate profits high and hence their stock price. Why is the Federal Reserve biased to keeping U.S. corporate profits high and their stock prices high? Is the Fed representing us all, or do they represent Wall Street? We know the answer to that question, which is why I asked that question. It's obvious. This institution, the way it's now organized, is working for Wall Street. This reversed the Obama bailouts quantitative easing that steadily inflated asset prices for real estate, stocks, and bonds. But the Fed has painted itself into a corner. If it restores the era of normal interest rates, that will reverse the 15-year run-up of asset price gains for the FIRE sector. This sudden shift on March 11th to 12th left SVB, quote, sitting on an unrealized loss of close to $163 billion, which was more than its equity base. Deposit outflows then started to crystallize this into a realized loss. SVB was not alone. Banks across the country were losing deposits. This was not a, quote, run on the banks, unquote, resulting from fears of insolvency. It was because banks were strong enough monopolies to avoid sharing their rising earnings with their depositors. They were making soaring profits on the rates they charged to borrowers and the rates yielded by their investments, but they continued to pay depositors only about 0.2%. The U.S. Treasury was paying much more, and on Thursday, March 11th, the 2-year Treasury note was yielding almost 5%. The widening gap between what investors can earn by buying risk-free Treasury securities and the pittance that banks were paying their depositors led the more well-to-do depositors to withdraw their money to earn a fairer market return elsewhere. It would be wrong to think of this as a, quote, bank run, unquote, much less as a panic. The depositors were not irrational or feeling to subject, quote, the madness of crowds, unquote, or falling subject to the, quote, the madness of crowds, unquote, in withdrawing their money. The banks simply were too selfish, and as customers withdrew their deposits, banks had to sell off their portfolio of securities, including the long-term securities held by Silicon Valley Bank. All this is part of the Obama bailouts and part of the unwinding of the Obama bailouts and quantitative easing. The result of trying to return to more normal historic interest rate levels is that on March 14th, Moody's rating agency cut the outlook for the U.S. banking system from stable to negative, citing the rapidly changing operating environment, unquote, of the banks. What they are referring to is the plunge in the ability of bank reserves to cover what they owe to their depositors who are withdrawing their money and forcing the banks to sell securities at a loss. Any comment on that section, D?
No,
No comment on that section?
it's just it really gets to me, all this the BS.
Yeah, it gets me too. For example, why try to use monetarism to handle that situation? Why not just keep the zero interest rates forever and let the Congress handle the situation with fiscal policy? Why should the Fed be involved at all?
It shouldn't be involved. It's like everything else, but Congress just sits back and is not doing their job. Stuff gets thrown to the Supreme Court that shouldn't be. That's Congress's job. It's like Congress
Just doesn't do its job.
isn't doing its job and is throwing it everywhere else.
And just doesn't do its job because of the donors who don't want Congress to do its job.
And what bothers me too is, you have them taking all this money from the banks and corporations, so they're acting on behalf of other people, and they're not looking out for the average person.
Yes. And not just not looking out for the average person, not looking out for poor people, okay, and not looking out for the system, for the stability of the system, but only looking out for their donors.
Exactly.
Uh,
And it repeats itself every certain amount of years. The years go by, then it's like they create the scenario.
yes. President Biden is trying to confuse voters by assuring them that the rescue, quote unquote, of uninsured wealthy SVB depositors is not a bailout. But of course, there's a bailout. What he meant was that the bank's stockholders were not bailed out, but its large uninsured depositors who were saved from losing a single penny, despite the fact that they did not qualify for safety and in fact had jointly talked among themselves and decided to jump ship and cause the bank collapse. What Biden really meant was that this is not a taxpayer bailout. It does not involve any money creation or a budget deficit any more than the Fed's $9 trillion in quantitative easing for the banks since 2008 had been money creation or increased the budget deficit. It is a balance sheet exercise, technically a kind of swap with offsets of good Federal Reserve credit for bad bank securities pledged as collateral. Way above current market pricing, to be sure. That is precisely what rescued, quote unquote, the banks after 2009. Federal credit was created without taxation. Next, the banking system inherent tunnel vision. One may echo Queen Elizabeth II and ask, did nobody see this coming, quote unquote? Where was the Federal Home Loan Bank Board? that was supposed to regulate Silicon Valley Bank? Where were the Federal Reserve examiners? To answer that, one should look at just who the bank regulators and examiners are. They are vetted by the banks themselves, chosen for their denial that there is any inherently structural problem in our financial system. They are, quote, true believers, unquote, that financial markets are self-correcting by, quote, automatic stabilizers, unquote, and, quote, common sense. So here, what Michael is highlighting is that the SVB crisis is not just an SVB crisis. It's a general crisis of the system because they are not moving to take care of the inherently structural problem in our financial system. They just deny that there is such a problem. And as long as they do so, and as long as they are the donors, or among the donors, uh, there can never be any attempts to fix the structural problem in our financial system. What Michael is implying is that that structural problem is the real overall crisis because it is the underlying cause for these failures to occur. He next says the regulatory corruption played a role in carefully selecting such tunnel-visioned examiners and regulators. Silicon Valley Bank was overseen by the Federal Home Loan Bank. The FHLB is notorious for regulatory capture by the banks who choose to operate under its supervision. He probably should have put supervision in quotes. Yet, SVB's business is not home mortgage lending. It is lending to high-tech private equity entities being prepared for IPOs to be issued at high prices, talked up, and then often left to fall in a pump and dump game. Bank officials or examiners who recognize this problem are disqualified from employment by being, quote, overqualified, unquote. Another political consideration is that Silicon Valley is a Democratic Party stronghold and rich source of campaign financing. The Biden administration was not going to kill the goose that lays the golden eggs of campaign contributions. Of course, it was going to bail out the bank and its private capital customers. The financial sector is the core of Democratic Party support, and the party leadership is loyal to its supporters. So as President Obama told the bankers, he should have said they're the banksters, who worried that he might follow through on his campaign promises to write down mortgage debts to realistic market valuations in order to enable exploited junk mortgage clients to remain in their homes. Quote, I'm the only one between you, the bankers visiting the White House, and the mob with the pitchforks, unquote. That is his characterization of voters who believed his, quote, hope and change, unquote, patter talk. The next section says, the Fed gets frightened and rolls back interest rates. On March 14th, stock and bond prices soared. Margin buyers made a killing as they saw the administration's plan is the usual one. So here's some more information on who benefits. Margin buyers made a killing as they saw the administration's plan is the usual one to kick the bank problem down the road, flood the economy with bailouts for the bankers, not for student debtors, until election day in November 2024. The great question is thus whether interest rates can ever get back to a historic normal, quote unquote, without turning the entire banking system into something like Silicon Valley Bank. If the Fed really raises interest rates back to normal levels to slow wage growth, there must be a financial crash. To avoid this, the Fed must create an exponentially rising flow of quantitative easing, Mike says. The underlying problem is that interest bearing debt grows exponentially, but the economy follows an S curve and then turns down. And when the economy turns down or is deliberately slowed down when labor's wage rates tend to catch up with the price inflation caused by monopoly prices and U.S. anti Russian sanctions that raise energy and food prices, I thought that was, he put it beautifully there. The magnitude of financial claims on the economy exceeds the ability to pay. This is the real financial crisis that the economy faces. It goes beyond banking. The entire economy is saddled with debt deflation, even in the face of Federal Reserve backed asset price inflation. So the great question, literally the quote, bottom line, unquote, is how can the Fed maneuver its way out of the low interest quantitative easing corner in which it has painted the U.S. economy? The longer it and whichever party is in power continues to save fire sector investors from taking a loss, the more violent the ultimate resolution must be. So, any comments on that final section?
Well, you clearly see that things aren't set up to benefit the average person.
You do very well see that.
And they play around that it benefits, that they make sure certain people don't receive any losses. And then two, with knowing with the salaries, when the average person's salary, when they can live comfortably, not dealing with, inflation, they worry about the fact of, the profit of the wealthy. But then I like that with the Russia brought into it, because they knew that with the sanctions on Russia that it was going to cause a problem.
Yes, they did, and yet they went ahead with it anyway. The Biden administration went ahead with it anyway, even though they knew it was going to contribute to inflation.
And they knew that they have people living on edge.
Yes, and the Fed, meanwhile, pretends that wage increases are the cause of inflation, so they create a war against wage increases by raising interest rates. Okay, and they don't acknowledge the main problem has been supply chain. And we know that because we see inflation has been slowing month by month by month. It has been slowing as the supply chains get straightened out and the price gouging starts to stop. And they also know, the Biden administration, okay, also knew that if they went to war, it was going to keep those prices up there, that it would no longer be just the supply chain problem and the price gouging, but shortages of food in the world economy and shortages of raw materials coming from Ukraine, okay, and Russia, that were going to keep those prices up there.
Right, like you want to have the people crash. You want to have more of a population that's struggling. You could say a large amount of the have-nots.
Okay, what I noticed about this last section is that, first of all, It may be the Fed is getting frightened, uh, but I haven't seen them roll back the interest rates yet. The expectation is that they're going to maybe stop increasing the interest rates or limit the increase in interest rates anyway, to a quarter of a point this time, okay, instead of half a point. I don't recall whether there was supposed to be a meeting of the Fed, today, okay, in order to do that. But okay, I haven't seen the Fed actually begin to cut yet. So it remains to be seen if that's going to happen. But the expectation is that it will. Okay. The other point I wanted to make about this section is that why should interest rates go back to normal, the Fed's interest rates? Why shouldn't they be ZERP as far as the eye can see? Why shouldn't the Federal Reserve uh, get out of the business of raising and lowering interest rates? Once again, as I said before, let the Congress use fiscal policy to manage inflation, okay, and to manage prosperity, okay, as well. That is the proper vehicle to do it
Right.
because they have the real power. In spite of the efforts by the Fed to raise these interest rates so high in such a short time, you see that has failed to kill the economy. The economy is still strong. The interest rates are a blunt instrument. They do not work as advertised by the Fed. We see that again very clearly here. We saw it during the 1980s when
Hmm.
Paul Volcker raised those interest rates. He had to raise the damn interest rates to 20% before the economy crashed. People considered that a success. I mean, I thought it was ridiculous.
Sounds
Ridiculous.
like- And then the whole thing too, where it said for the the bailouts for the bankers and not the student debt. What does that tell you?
Well, what it tells me is that the donors legislate for themselves and spend on themselves and don't legislate for the people. It tells me we need to get the donor money out of politics. It tells me we need to dump the corruption campaign more than ever. And it's really got to start up because both in the financial crisis of 2007, 2008, 2009, and the ensuing years, people got screwed. And the top of the economy got richer and richer, okay, and richer. And that the powers that be are trying to play the same game here.
Yes, they are.
And we have to stop them. And the reason I wanted to go through Michael's two articles was because he was looking at it from that point of view. He was not looking at it um, uh, like a technocrat, but trying to analyze it in the full detail what the mechanisms were that were causing the crash. He gave a very good explanation of the crash anyway. I'm not saying he did not, but he turned his eyes to the larger societal issue and to the structural problems of the banking system and pointed out that is the real crisis and that's what we have to deal with, and that goes beyond both, uh, that actually goes beyond the banking system. And I thought that that construction or that framing of the article was the proper framing of the article. It keeps the major issues in view. And of course, that last question: how can the uh, how can the Fed actually maneuver its way out of the low interest QE corner in which it has painted the U.S. economy? Well, it can recognize that that's not necessarily a corner for it to handle and leave it to the Congress to handle that. How can the
Yeah.
Congress handle it? The Congress can redistribute the wealth so that the asset price inflation is lowered. Is lowered.
Congress could actually do their job.
The Congress can regulate the people who have to be regulated, specifically the monopolies. It can tax the people who have to be taxed. It can remove the excess money from the top levels of the economy in various ways. That will stop the asset price, inflation. So I wanted to cover those two things. I know I'm running a little over, but I want to quickly move to two other pieces that I had scheduled. The first is a piece about what some of the Democrats are trying to do now. It says the Dems. It's not actually Dems. Okay, it's the part of the party that is concerned about the good behavior from the banks. Uh, Let me find that. So the headline of that article, which appeared in Common Dreams, is okay. Here's a picture of I think it's Gary Becker, but it says it's Greg Becker here, the CEO of Silicon Valley Bank, at a conference on May 3rd, 2022, in Beverly Hills, California. So that's what Becker looks like. Dems push the Biden DOJ to probe possible, quote, criminal violations by the SVB execs. Quote, SVB officials showed a pattern of risky and questionable decision making that may have contributed to the bank's instability, unquote, wrote Senators Elizabeth Warren and Richard it's Blumenthal. This is by Jake Johnson on March 15th. Senators Elizabeth Warren and Blumenthal demanded Tuesday that the Biden Justice Department Securities Exchange Commission investigate whether Silicon Valley Bank executives violated civil or criminal law, quote unquote, in the lead up to the firm's collapse, which sent shockwaves through the entire U.S. financial system. Quote, this was a colossal failure in asset liability risk management, unquote, Democratic senators in a letter to SEC Chairman Gary Gensler and Attorney General Merrick Garland. The letter was first reported on CNBC on yesterday morning. Lawmakers pointed to recent reporting detailing how SVB officials showed a pattern of risky and questionable decision making that may have contributed to the bank's instability and collapse. So anyway, that's that particular story. So they have brought some pressure onto Silicon Valley Bank and called for civil and criminal investigations. The former CEO of the bank, of course, the bank now doesn't have a CEO because it's been taken into receivership by the FDIC. So Greg Becker, SVB's former CEO, sold millions of dollars of shares as recently as late last month. In other words, just a few weeks ago. The bank's leadership has also come under fire for dishing out bonuses hours before the federal regulators took over last Friday. In a letter to Becker earlier this week, Warren, a member of the Senate Banking Committee, slammed SVB for lobbying against bank regulations in recent years and argued that, quote, you have nobody to blame for the failure of your bank but yourself and your fellow executives, unquote. Quote again, SVB failed while its chief risk officer position sat vacant for 8 months as its financial situation deteriorated because it failed to address two key risks: concentration in your client base and rising interest rates, unquote. The Massachusetts Democrat wrote, and quote again, this is a failure of Banking 101, which what one analyst called sheer incompetence. Had SVB been subject to Dodd-Frank rules undone by a 2018 GOP law, a law pushed by the Trump administration, the bank would have been required to maintain strong liquidity and capital requirements and conduct regular stress tests that would have required SBD to shore up its business to weather the type of stress it experienced last week. Quote, you lobbied for weaker rules, got what you wanted, use this opportunity to abdicate your basic responsibilities to your clients and the public, facilitating a near economic disaster, unquote. So that's the point here, that the bank execs got a tongue lashing, and there was a call for investigations and prosecutions. And here's another piece, this time also from Common Dreams. I'll share that one too. That's about some moves that Warren and Katie Porter made on Wednesday, I believe. Warren and Porter lead SVB Act to repeal Trump-era bank deregulation law. It was a 2018 law backed by Republicans and dozens of Democrats, which allowed banks to, quote, load up on risk to boost their profits, unquote, endangering, quote, our entire economy. This one's by Jake Johnson on March 15th. Senator Warren and Representative Katie Porter unveiled new legislation Tuesday, it was on Tuesday, to repeal the section of a Trump-era law that weakened regulations for banks with between 50 billion to 250 billion assets. That those banks that failed were in that range. A move that experts and lawmakers have blamed for the collapse of Silicon Valley Bank and the resulting turmoil. So a number of analysts are saying, correctly, I think, that the roots of this crisis were in the Trump administration and its change to the Dodd-Frank law. In 2018, Warren said, this is a quote from her, I rang the alarm bell about what would happen if Congress rolled back critical Dodd-Frank protections. Banks would load up on risk to boost their profits and collapse, threatening our entire economy, and that is precisely what happened, unquote. Said Warren, who's a Democrat from Massachusetts. Quote, President Biden called on Congress to strengthen the rules for banks, and I'm proposing legislation to do just that by repealing the core of Trump's bank law, unquote. That law, authored by Mike Crapo, Republican of Idaho, I hope that's the pronunciation and not Crapo, and backed by dozens of Democrats, raised, I couldn't resist that, raised the asset threshold for more stringent regulations to 250 billion or higher. I know it was a cheap shot. Exempting firms such as Silicon Valley Bank, a major venture capital lender that controlled around 212 billion from enhanced liquidity requirements and more frequent federal stress tests imposed on banks considered systemically important, quote unquote. SVB's leadership specifically lobbied for a higher threshold, insisting the tougher regulations were unnecessary, even as experts and lawmakers raised serious concerns that gutting them would increase the risk of bank failures and cascading effects on the financial system. Quote, Americans deserve to know their money is safe when they deposit it in the bank, unquote, Porter, Democrat of California, said Tuesday. 2018, politicians rolled back critical regulations protecting Americans' deposits, ignoring the warnings from financial experts in favor of Wall Street special interests. I'm calling on Congress to restore common sense guardrails that keep corporate greed in check and restore confidence in our financial system. Titled the Secure Viable Banking Act, the SVB Act, Warren and Porter's legislation would place more stringent financial regulations on institutions like Silicon Valley Bank by reviving safeguards for firms with between 50 billion and 250 billion in assets. And the Federal Reserve is now considering stronger regulations for banks with between 100 billion and 250 billion in assets, Reuters reported late on Tuesday. Warren and Porter introduced their bill with the support of 31 Democrats in the House and 17 members of the Senate Democratic Caucus, including Senators Bernie Sanders and Ed Markey. Quote, taxpayers should not have to pay for the mistakes and mismanagement of big bank executives, Markey said in the statement. Well, there are more statements like this. But in the Senate, 16 Democrats and Senator Angus King, an independent of Maine, supported the Trump bill in 2018, giving Republicans the votes they needed to overcome the filibuster. One of the Democratic supporters, one of my senators, Mark Warner of Virginia, defended the 2018 law over the weekend, telling ABC News he believes it, quote, put in place an appropriate level of regulation on mid-sized banks, unquote, and that, quote, these mid-sized banks needed some regulatory relief, unquote. So Warner doubled down on what he did that resulted directly in this banking crisis. These people have no shame. They will look you in the eye and will double down even when a catastrophe has happened. I mean, nothing worse than this catastrophe could have happened to show that they were dead wrong, and here they are, not even admitting error. One of the 16 Democrats who was included in here was John Tester, who's a senator from Maine. Okay, and of course, he sent me a solicitation for a contribution. He wants a contribution for being one of those responsible for the current bank failures and the scare we've all been facing now. And he wants a contribution. He was wondering why his contributions were so low. I can certainly answer that question for him. Also, he held a fundraiser in Silicon Valley earlier this week, just days after SVB collapsed.
A nice guy.
Somehow, I don't think he did very well in that particular fundraiser. Anyway, I thought that was funny. There was one more thing I wanted to cover if I had time. Of course, I don't have time. It's already 10:21, but it was so good that I might want to cover it anyway.
Go ahead. These people have no shame.
Yes, they do have no shame. Uh, so let me share this with you. This is from the Macro Compass. Uh, it's from a guy who identifies himself, okay, as Alf, which actually are his initials, okay, ALF. Uh, March 12th, he published a piece on the banking crisis on his Substack blog called The Macro Compass. And I wanted to go into that as briefly as I can. Silicon Valley went belly up in about 30 hours. And no, it's not the Fed's fault, said he. I'm not sure I agree with that, but anyway, it's the
And
result of
you don't
very.
have the article up.
Oh, I don't have the article up. Thank you.
You're welcome.
I don't have the article up. So let's see. Let's share the screen. Uh, there it is. Okay, his name is Alfonso Pecchiatello, actually. And the ALF are the first three letters of his first name. Silicon Valley went belly up in about 30 hours, and no, it's not the Fed's fault. It's the result of a very concentrated funding base. Okay, in other words, a relatively few people who were funding the bank, a relatively few depositors the bank was very dependent upon. Okay, and embarrassingly, he says, had bad market risk management and a ton of moral hazard at play. The piece will attempt at answering the questions all of us have been asking. What exactly went wrong for a 200 billion balance sheet bank to go down so fast? In 30 hours. That's fast. How serious are the spillover effects? Is the entire U.S. banking system in trouble? How will the Feds and markets react? And the first section of this is disastrous risk management. What SVB did with their investment portfolio is either a signal of enormous incompetence or of outright moral hazard at play. Gamble away billions as policymakers will rescue you anyway. Actually, that didn't happen. They did not rescue the stockholders. They did not rescue the executives who were running the place. They fired them, and what they're bailing out is the depositors. I can't believe incompetence reaches this level, says Alf, and there are some clear hints of moral hazard at play. First of all, why do banks buy all these bonds? Post the great financial crash, GFC, regulators forced banks to own an amount of high quality liquid assets, HQLA, at least big enough to meet a stressed outflow of deposits for 30 days. They need to have a liquidity coverage ratio, LCR, which is above 100%. What qualifies as high quality liquid assets, HQLA? Reserves at the central bank, treasuries, but also corporate bonds and mortgage bonds to a certain extent. Uh, and he shows a graphic there, stock of high quality liquid assets, the ratio of that to net cash outflow over 30 days. Uh, and in yellow, he highlights qualifying marketable securities from sovereign central banks, the PSEs, and multilateral development banks. I've forgotten what PSEs are, so Maybe somebody could help to fill that in for me. And of course, he highlights also qualifying central bank reserves. Uh, and then under level 2A assets, he highlights qualifying corporate debt securities rated AA minus or higher. And then level 2B assets, which is supposed to be a maximum of 15% of the HQLA handling. Qualifying RMBS, qualifying corporate debt securities rated between A plus and BBB minus. And then you get from that the total value of the stock of HQLA that a bank has. As a result of LCR regulation, banks all over the world have flushed their balance sheets with trillions of bonds. Such a large amount of bonds on the balance sheet also comes with risk, though, right? Interest rate risk comes to mind. If you purchase treasuries and yields rise, you lose money. That's why banks hedge the lion's share of the interest rate risk coming from their HQLA investment. The mechanism is simple. When you buy treasuries, you lock in a fixed yield you receive and rising interest rates that represent the risk. To hedge that risk, you enter into an interest rate swap. This time, you pay away a fixed yield and received variable payments in exchange. There you go. You received a fixed rate when buying treasuries, and you pay a fixed rate in the swap, a hedge. Treasuries generally yield a bit more than swaps, and that's where you make your money.
Mhm.
Swap spreads. And so he has a little diagram here that shows the idea of the spread when you're hedging your bet. Now, here comes the argument. In this example, SVBA would buy 10-year treasuries and enter into a swap to hedge the interest rate risk. SVBA pays a fixed 10-year rate, OIS, in the swap, and receives the variable overnight Fed funds rate for the next 10 years, plus a spread, swap spread. This would allow SVB to hedge the interest rate risk and earn a small spread on their HQLA portfolio. The problems? SVB had a gigantic investment portfolio as a percent of total assets at 57%. The average U.S. bank has 24% and 78% was in mortgage-backed securities. For example, Citi or J.P. Morgan would have, say, 30% as opposed to 57%. So, going further, and most importantly, and this is, of course, Al's point, in 2022, they did not hedge their interest rate risk at all. The duration of their huge portfolio before and after interest rate hedges was the same. Effectively, there were no hedges. This means SVB was not applying basic risk management practices and exposing its investors and depositors to a gigantic amount of risk. Economically speaking, a 120 billion bond portfolio with a 5.6 interest rate, non-hedged duration means that every 10 basis point move higher in 5-year interest rate lost the bank almost $700 million. 100 basis points translated to a $7 billion economic loss. 200 basis points translated to a $14 billion economic loss. Basically, the entire bank's capital wiped out. As the tech IPO boom faded, deposits stopped coming in 2022. Recently, depositors started taking their money away and forced SVB to realize these huge losses on bond investments to serve its deposit outflows. The concentrated nature of the deposit base and awful risk management meant SVB went belly up real quick. That many people are now calling for a blanket bailout, but evidence that moral hazard was at play are too big to be ignored, and we should not reward moral hazard. Companies go belly up, it happens. Perhaps it was just huge incompetence at work or bad luck. But please consider the evidence that moral hazard played an important role. Here are three interconnected facts which are hard to ignore. First, the outrageous use of accounting tricks. HQLA investments can be booked either under the available for sale or held to maturity accounting regimes. The available for sale unrealized gains and losses do not hit the P&L of the bank, but they do show up the capital position of the bank. Booking bonds in held to maturity, HTM, instead prevents gains/losses from showing up at all. Convenient, right? See for yourself. SVB had a gigantic bond book and made an unusually large use of the convenient HTM accounting regime. The unrealized losses as per December 2022 in the HTM portfolio alone amounted to $15 billion, enough to wipe out the bank's capital, but conveniently hidden through the abnormal use of this accounting trick. You don't book $90 billion of unhedged bonds in HTM by mistake or incompetence. This is moral hazard. The graphic following shows the SVB investment portfolio between December 2021 and December 2022. Okay, and you can see from that, if you go through it, okay, I will not, that the hedges that were in the investment portfolio in 2021 are gone by 2022. And the unrealized losses are huge, are 15 billion, as Alf had said. 2, not hedging, just ignorance, you say. In December 2021, SVA had about 10 billion of interest rate swaps. Probably too little to hedge the entire interest rate risk, but that's not my point. In their financial statement, they show a clear understanding of what these swaps are for. Fast forward to December 2022, and basically all these hedges are gone. Okay, and he circles them in red, the interest rate swaps. They were 10,700 in December 2021. That is 10,700, okay, is in millions. So they had 10.7 billion in hedges, okay, in December 2021. They dropped that down to 550 million in hedges in December of 2022. So the important point here is, just commenting on this article, we know Greg Becker sold a huge amount of SVB stock basically a month ago. He had access to these financial records. He knew there were no hedges. He knew that was risky. He might have sensed the coming run, okay, on the bank. He might even have set it up in that way for various reasons that we are not aware now. But you see from this article, that there was good reason to wonder because of this, as Al says, vast use of accounting tricks and a voluntary reduction of hedges. Number three, that urge to stay away from tighter regulatory scrutiny. And here he talks about how SVB's management repeatedly lobbied to increase the cap for lax by regulatory scrutiny and conveniently remained 20 to 30 billion dollars below the 250 billion threshold. In other words, this bank was growing very, very, very fast and taking in depositors hand over fist. But in the end, they were careful to remain below 20 to 30 billion below the 250 billion threshold. So Al says it is hard to deny a decent amount of moral hazard was at play here. So should the government fully bail SBV out or only make uninsured depositors whole? Is SVB a canary in the coal mine for a systemic banking crisis? And what about the Fed reaction, okay, and the market impact? I'm not going to go into this, okay, any further, but I wanted to make those points. Of course, as you know, SBV has been taken into receivership, and the government has decided to make the uninsured depositors whole, but has also decided to fire the executives and to give, as it's phrased, a haircut to the stockholders. Basically, the stockholders have lost all their value in the bank. So, I have the feeling that was a pretty comprehensive treatment of some of the larger issues involved, okay, in the Silicon Valley Bank affair, and that was put into very good perspective by the Michael Hudson articles. The larger issues were put into perspective. The legal issues were put into perspective by the Warren Porter moves. And the ALF piece showed some of the evidence for thinking that there might be a legal case here. So I think that's a pretty well-rounded stream in terms
Yes.
of, okay, what it showed. Okay, now there are many more issues. Specifically, Nathan Tankus had a very long blog that raised many issues, but these were kind of raised in the context of an orientation towards the agenda that Nathan and Rowan have in terms of their research agenda for the banking system. And I didn't think that was as important to highlight as the general considerations that were brought forward by Michael Hudson, by Warren and Porter, okay, and by Alf. So I'm going to move to consider the comments, at least some of the comments, okay, even though people are gone. Solana's here. Kay Ryan was here. I know that she's left after a while. Okay, Lana's going to an American Bankers Association class on compliance, she says ironically. I'll bet there's got to be a lot of interesting talk there. She points out bank deposits are assets and the bank's debt, okay, is a liability. Yes, our assets, but the bank's liability, not the bank's assets. Steve Wolfbrand says, smash the like button. Thank you, Steve. And smash the share and subscribe button too. And please visit my Buy Me a Coffee place and my Patreon account. Ghostot says, my Citibank sis from Texas is in town and reaffirmed they're pulling out of several countries. She couldn't say which. Anyone care to speculate? Maybe they're going to pull out of China. I don't know. I wonder if they've already pulled out of Ukraine and Russia. Steve Wolfbrand says, our governor up to his ears in SVB. That wouldn't surprise me at all. Ghostot says, at this point, any conspiracy you can think of is probably connected. Lana says, the raising of interest rates has done a lot of damage, including me losing my job. They did it too much too fast. Smaller hikes and then pause might have been less impactful. But it also would not have had any effect on the labor market at all. I think the more basic point is the Fed should stay out of it. It should keep its interest rates at zero. Let the Congress handle it, because monetarism does not work. As Mike Norman would put it, it's a false religion followed by fanatics, and it's damaging the country. Kay says the Fed caused this. There's a lot of blame to go around. I forget his name, but that MMT trader guy, Mike Norman, has been saying he sees no indication for recession. I know there's no indication for recession yet. Federal Reserve's emergency loan program may inject as much as $2 trillion into the U.S. banking system to ease the liquidity crunch, according to J.P. Morgan. So they're adding more quantitative easing. Congress abdicated their responsibility and threw their hands up. They won't do anything and expect the Fed to just handle it. Lana points out to Steve that it is Mike Norman. And Ghostot says, thanks, Lana Dell. Hates the clock. I've been racking my brain. Face green smiling. Ghostot says, Joe's Bridge is back. Kay says, well, I'm out of here for tonight. Love you all. We love you too, Kay. And Ghostot says, 50 Dems, 33 House, 17 Senate. And Lana says, good night, Kay. And Lana says, Alfonso, Mamma Mia. I have now finished the comments, unless there are some other comments. Oh, Ghostot says, last night I was chatting from a 10-minute lag. 10:44. Anyway, I think it's time to say goodnight.
Yes, it is.
And I thank you for being here, folks. And Dee, I thank you for being here. And
Yes, I really enjoyed these articles. You know, they were, you know, simplistic enough to really provide understanding. And it just really,
yes, I thought so too. I thought the audience for these articles was people.
right.
Okay, except the Alpha article, the audience for that, okay, was investors, of course, but the
Right.
language was still simple enough to understand, to have a
Yeah.
common sense understanding of what was going on. So I thought that was real good too. But I was really impressed with the framing of the whole matter by Michael Hudson. Okay, I thought he did a great job of framing the issues, not just the Silicon Valley Bank issue, but the larger issues for the banking system and for the economy. And I hadn't seen other people doing that. I've been through so many articles yesterday and today on the Silicon Valley bank crisis. My head is spinning from all the articles, and I wasn't sure I was going to make the show tonight. I was working all day to prepare. Okay, but about 4 o'clock, Okay, I got to brainstorm about what it was important to talk about.
Finally hit me.
Yeah,
You look at so many things, and it's just
yeah, I know you're dizzy. After a while, you're dizzy.
yes, and you're like,
You
where
know,
am I
for
going?
to look at, and your blood pressure is rising on top of that. So anyway, thanks again, Dee. It was fun.
Yes, it was fun, and I'll see you tomorrow night.
Okay, I should say tomorrow night we're getting back to the fundraising of more CPC members. I guess we've got 5 or 6 to go right now, or maybe 7. And we're going to be finished with that examination soon. And of course, we, you know what the conclusion is going to be, but the important thing is that conclusion is going to be striking. And you know what that's going to result in. It's going to result in attempts to smear us for doing a litmus test that is far too strict. Well, we have answers for that. We do have answers for that. So,
And when I look at today, just going over these articles, they all have to be replaced. The whole system has to be replaced.
yes, the Congress people have to be replaced.
Right, they're not doing their job.
Okay, because as you know, Kay said, she said okay, it was the Fed's fault. Well, what about the Trump administration cutting down the effectiveness of the Dodd-Frank bill? I mean, that was the inception of this.
Hmm.
They're bowing to Greg Becker's pressure. Why did they bow?
Like
Because
the whole
Greg
thing with
Becker,
deregulation,
yeah,
with
Silicon
the
Valley,
railroad.
yeah, Silicon Valley Bank probably, and its depositors probably did a lot of contributions.
Yes, it's the contributions, and then you also have with the same thing with deregulating with the railroads. I mean, all this deregulation with Trump. That's what they wanted.
Yes, they wanted the deregulation, and now they get catastrophe. Okay, as a result of that, and then people like John Tester, okay, and Mark Warner, they double down on it. Oh no, we didn't make any mistakes.
No,
I mean,
not us.
who could have predicted? Who could have predicted? Oh, Elizabeth Warren predicted in 2018. She told you what was going to happen. You
But they
both
knew it.
didn't listen.
They got payoff for it.
Anyway, this puts
Campaign donation.
Katie Porter in a better position for her run for the Senate,
Hmm.
I think.
Okay.
I guess I can take my red beret off right now.
I guess so.
Okay, good night.
Good night.
Have a good night.
Yes, you too.